For decades, General Electric wasn't just a company, it was an institution. One of the original 12 stocks on the Dow Jones Industrial Average in 1896. It was synonymous with American industrial might. But in 2020, the SEC handed down a $200 million fine for accounting misconduct. The charge? Fraudulent bookkeeping in its power division. And this was just the crack that finally shattered the facade. Here's what nobody talks about. The collapse of one of America's most iconic companies traces back to a single, deeply embedded accounting trick. Not a scandal, but a system. The question is, how did the most valuable company on earth build a $200 billion lie? To understand the fraud, you have to understand the man who built the machine. In 1960, a young chemical engineer named Jack Welch joined GE for $10,500 a year. He nearly quit a year later, disgusted by the bureaucracy. An executive convinced him to stay, promising a small company feel. It was a fateful persuasion. Welch would go on to become CEO in 1981, and he would reshape not just GE, but the entire philosophy of American corporate management. His core rule was brutally simple. Every business unit must be number 1 or number 2 in its market. If it wasn't, Welch would fix it, sell it, or shut it down. It created a culture of relentless, short-term performance. The results were staggering. When Welch took over, GE was worth $14 billion. By the time he retired in 2001, it was the most valuable company on the planet, worth $600 billion. The secret to that growth wasn't just better jet engines or power turbines. It was a radical expansion into finance. Welch transformed GE Capital from a small financing arm into a behemoth that generated 40% of the entire company's revenue. For investors, it was perfect. GE delivered smooth, predictable earnings quarter after quarter. It was a machine for beating analyst estimates by a penny. But how do you guarantee smooth profits in inherently volatile industries like power generation? This is where the accounting trick comes in. It's called residual value accounting. On paper, it's simple. When you buy a big asset like a gas turbine, you estimate what it'll be worth at the end of its life, and subtract that from the cost. A higher estimated residual value means a lower annual depreciation expense on your books, which means higher reported profits. GE's power division used incredibly aggressive assumptions about what its equipment would be worth in 10 or 20 years. It was a self-reinforcing loop. Higher reported profits kept the stock price high, which made it easier to attract talent and financing, which allowed more deals, which required more aggressive accounting to keep the profit machine running. Here's the part nobody talks about. The system wasn't a secret loophole. It was a widely accepted practice within the industry. The problem wasn't that GE used it. The problem was that they used it as the primary tool to guarantee earnings targets for Wall Street. When Welch retired, he walked away with a $417 million severance, the largest in history at the time. His successor inherited a company whose profits were fundamentally dependent on optimistic, long-term guesses about asset values. For a while, the illusion held. GE kept climbing. But the 2008 time-per-450 place physical ripped through GE Capital, exposing the fragility of the financial engine that powered half the company's profits. The industrial side of GE had its own ticking time bomb. In its power division, the company had been booking profits on long-term service contracts based on those sky-high residual values. But what happens when the market for those turbines collapses? As the 2010 seconds wore on, demand for new gas turbines cratered. The residual values GE had assumed were wildly optimistic. The profits they'd already reported were a mirage, and the company was sitting on billions in assets it had overvalued. The turning point wasn't a single event. It was the slow, inevitable collision between an accounting fantasy and economic reality. The decision that killed them wasn't Welch's, but the system he created left them no choice but to keep digging. The SEC's investigation didn't just find aggressive estimates. It uncovered a pattern of misconduct where power division executives manipulated accounting to meet internal profit targets, year after year. The $200 million fine was just the penalty. The real cost was the destruction of trust. It proved that the earnings machine that had powered GE's rise was built on sand. The fallout was immediate and brutal. GE was forced to slash its dividend to a single penny, a symbolic surrender to reality. The stock, once the blue-chip investment in every pension fund, entered a freefall. The company that was once 33rd on the Fortune 500 saw its profitability rank collapse. By 2023, it had fallen to 64th in the Forbes Global 20. The $600 billion giant had been hollowed out. In 2021, the final act was announced. GE would break itself up into 3 separate, smaller public companies. The 122-year-old conglomerate, once the definition of American capitalism, was dissolving itself. So what's the lesson? It isn't that GE cooked the books in a dark room. It's that they created a system where short-term financial performance, enabled by a technical accounting rule, became the only thing that mattered. The incentives were perfect. Executives were rewarded for smooth earnings. Analysts demanded them, and the accounting provided the illusion. The system fed itself until the underlying business reality made the illusion unsustainable. GE's story proves that the most dangerous frauds aren't always about outright lies. They're about building a machine that rewards everyone for believing a beautiful, optimistic story about the future.